In this episode, we walk through the Trump budget bill and some real ways it can impact your tax return in this year and years to follow. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello, my name is Brenton Harrison of New Money, New Problems, and your host for the New Money, New Problems podcast. I would ask that you give me some grace in the quality of this audio and video recording. We actually had to make an unexpected trip up to take care of some family matters, although I will be back by the time this episode is posted. Maybe it's just me, but I'm a little weird about letting people know I'm out of town while I'm out of town. And as a result, we are recording on the webcam today and seeing what we can do. So please give me some grace, but I do think this is an episode that I wanted to get out because this is an episode where we're going to go through some of the changes in the Trump budget bill that I actually think will have an impact either temporarily or permanently for our typical listener. Now, I'm going to tell you this is going to be a tax-dense episode. And if you don't have some pretty, high level familiarity with some of these terms, it may be a tough listen, not in the sense that you shouldn't listen to it, but I do want you to have some perspective. We do not do a lot of hard selling on this podcast. In transparency, I may do a little more in the future, not because we're, starved for business. We have been blessed at New Money, New Problems, but because the fact of the matter is we do talk about some concepts where even though I want you to know what you're doing and have some familiarity, it is best discussed and partnered with a professional. So we're going to break down some of these topics, and we're going to start by, in the first half of the episode, talking about some tax deductions that you might have heard about that may benefit you, may not benefit you, but are temporary changes that expire in the next few years. And then after the break, we're going to talk about some of those permanent changes that, at least until Congress decides that it's no longer permanent, are things that may represent long-term opportunities for your strategy. So let's talk about the first thing that we've seen a lot of news about, and that is the fact that there is apparently no taxes on overtime pay and tips. This is something that I'm seeing a lot. That's kind of a half truth. So let's first break down who is eligible, starting with tips. You cannot just, if your business does not cater itself to receiving tips, put out some tip jar and say, hey, I don't have to pay taxes on this money. So rather than charging you for this service, just, I'm going to charge you a lower amount and put the rest in a tip jar, for lack of a better phraseology. That's not how it works. In order to be eligible for this tax deduction, you have to be in a business that is already catered to receiving tips. So this is something like an esthetician, a barber, or someone who works in a salon, a waiter or a bartender. Industries like that, there is a half truth that if you make a certain amount of income or less, you would not have to pay taxes on it in a roundabout way. In order to explain that roundabout way, you have to remember how taxes work in the first place. You start with the total amount of money that you earned. You can then reduce the amount of income on which you pay taxes using above the line tax deductions. So those are things that anybody can access. Things like the amount that you put in your retirement account, the amount that you put towards pre-tax employee benefits like a health savings account, which we're going to talk about later in this episode. Anybody can use those. After you've reduced your income using those deductions, you then have to choose between either the standard deduction or itemizing your own expenses. You can lower that taxable income even further. And then after you have done that, you're in this kind of weird no man's land, because this no tax on tips is a really unique deduction that comes into play after you have taken your above the line and below the line deductions. What that means is any taxpayer can use this as well if they're in an industry that caters itself to tips. So this is something where if you are in the income bracket where as a single filer you make less than $150,000, if you're a joint taxpayer and you make $300,000 or less, you are able to use this deduction in full up to $25,000. Now, just like many deductions, after you reach those income levels, there's a phase out, meaning your ability to take the entire deduction starts to reduce based on how much you're earning. For this particular deduction, that phase out for a joint filer is between $300,000 and $550,000. So that's a pretty high income range, not necessarily for tips. I don't know that many bartenders who are making that range, but when you consider the fact that this is relevant to overtime pay as well, that's a pretty high income range where if you're receiving overtime and time and a half, you can start to take this deduction. So this is a pretty unique deduction that ropes in a larger percentage of people than you're probably thinking when you consider overtime pay being counted that you can use for the next few years. I say next few years because, as I discussed, this is a temporary tax deduction that expires at the end of our current president's term. But let's move forward to another temporary tax deduction, and that is car loan interest. We did kind of a preview of the tax bill about a month and a half ago, and we talked about car loan interest. This is another one that you may see online and get really excited about, that in my opinion is very misleading in terms of how many people will actually get to benefit from it. So for example, maybe you're paying $500 a month and $150 of that amount is going to interest. Well, this deduction is trying to put you in a position where certain people can claim that 150 in interest each month as a tax deduction. Now, this is another tax deduction that ends at the end of 2028, the end of our current president's term. And the way that it works is you have to first meet the income requirements. Income requirements meaning as a joint filer, you're making less than $200,000, as a single filer, less than $100,000, and you can deduct up to $10,000 per year of the interest that you pay on your car loans. Now, this is another deduction that is joining QBI and no tax on tips and overtime, in the sense that is a deduction that you can use regardless of how you file your taxes. It is neither an above the line tax deduction nor a below the line tax deduction. It's a deduction that occurs after you have already taken those previous categories. So it's up to $10,000 in interest, but there are some very specific requirements in terms of who can claim it. It can't be a loan that you took out years ago. You can't start claiming the interest that you're paying on a loan that you took out 2 years back. It has to be a loan that was started this year or beyond, meaning between now and the end of 2028, and you can't deduct a lease payment. It also has to be a new car. And lastly, the final assembly of that car has to be in the US. Now, that does not necessarily mean that it's a US based auto dealer. It doesn't mean that you all of a sudden have to go buy like a Dodge or a Jeep. But if you combine the fact that it has to be a loan that you just got for a new car whose final assembly occurs in the US and you have to meet the income requirements, this is not something that I see a tremendous amount of high income earners being able to access. But if it's something where maybe you're buying a car for a child who's in your home, or if you do simply happen to be in the market for a new vehicle whose final assembly occurs in the US over the next few years, this is something that is also a deduction that, combined with the ones that we're going to talk about throughout the balance of this episode, could represent a strategy you can use for a short period. Next up, state and local taxes. And this is one where we're going to combine a temporary change with a permanent change that's relevant to business owners, because state and local taxes was a huge part of the discussion surrounding this bill. The reason is, in the Tax Cut and Jobs Act in the first Trump administration, they instituted a change that radically increased the tax burden for people who lived in high income areas that are high state tax areas. And that was the limitation of state and local tax deductions. So what people would do is, if they itemized their taxes and claimed all of their own individual deductions, they would, in years prior to the Tax Cut and Jobs Act, be able to claim all of their state and local taxes as a deduction. So if you had paid $30,000, you would be able to use that as a deduction on your itemized form. Well, the Tax Cut and Jobs Act changed that, and it put a limit on the amount that you could deduct at $10,000. Now, some might say that this was a way of making sure that high income earners paid their fair share of tax. If you're looking less charitably on it, you might say that the majority of states that charge a very high income tax rate are blue states, and this is something that was meant to make them pay a higher amount in taxes. Regardless of whether you fall on that spectrum, it was something that people didn't enjoy because there are Republicans in blue states as well. There are Republicans who live in cities that charge city tax as well. And it was something that they were hoping to have repealed or lifted under this bill. Well, they did not lift it, they increased it temporarily. So right now, the limitation on state and local taxes that you can take is $10,000. That is going to increase from $10,000 to $40,000 temporarily. This is another one that ends in that 2028, 2029 window. Now, there is a phase out for this as well, but it's a pretty high phase out. So for joint filers, your ability to take that full $40,000 or up to $40,000 is reduced once your income goes between $500,000 to $600,000. And then if you're a single filer, it's between $250,000 to $300,000. Those are pretty high income levels. So I do see this as one that many people are going to use to their benefit over the next few years. Next up, and this is the last temporary change that we're going to talk about before the break, is an account that I actually do think has some merit, but I also think that they cut themselves off at the knees based on the way they named it. It is the Trump account for minors. And in transparency, I've been trying to figure out if that's the actual name or whether it's just like the nickname they're giving it. But this is a really unique account, and it's kind of a blend between a 529, an UGMA, which is a Uniform Gifts to Minors account, and an IRA that you might open up for your child. This is another one that's only available through 2028, and it has some unique benefits. First, what is it for? Well, instead of the limitations of a 529, which is for education expenses, instead of a Roth IRA where your child, they can access, what's been put in with some limitations, but they can't access gangs until they're 59 and a half. Instead of an UGMA account where there's unfettered access for the child once they reach the age of majority and you kind of lose the ability to guide them. This is a blend of all of those things. The money has certain qualified expenses for which it can be used, and those are college, so school-related expenses, small business purchases, and also first-time home purchases, which is really unique. Now, the thing is, if you use it for one of those qualified expenses, you'll be able to have any growth on these funds taxed at long-term capital gains rates, which is 0%, 15%, 20% based on your income. I would say the vast majority of middle America, even high income earners, are going to fall in that 15% range. Now, if you don't use it for a qualified expense, it's almost like taking an early withdrawal from a retirement account. You would have to pay a 10% penalty, and that money would be charged to your income when it comes to what you pay taxes on at the end of the year. In terms of contribution limits, you can contribute up to $5,000 per year per child between now and the end of 2028. Now, in addition to that contribution limit, you can use it if your child's already born, but if your child is born between 25 and 28, the government will actually kickstart the funding of that account at $1,000, and employers can also contribute up to $2,500 that doesn't count as income to the parent. Now, there's some restrictions in terms of what you can invest these accounts in, and that restriction is the money that's in the account has to be invested in a diversified fund that tracks U.S. stocks. So that means that you can't go in and invest in single stocks, even if they are U.S.-based companies. It has to be a diversified fund that tracks U.S. stocks. So think like the S&P 500 instead of you individually investing in like NVIDIA or Apple or Tesla stock. So in theory, this is a really cool account, but in transparency, I've already talked to some clients since this bill has passed to at least make them aware of it. And from several of them have gotten the response that truly, based on the name, it's not something that they plan to pursue. So I know you don't come here for politics, even though I do clearly splash it in a little bit from episode to episode, but that's my take on the Trump account. Those are some of the temporary changes. There are several, as well as permanent changes that we can't fit in one episode. But after the break, we'll talk about permanent changes that will have an impact on you as a taxpayer.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
All right, let's go through some of the permanent changes, allowances, deductions that have been cemented into law. Permanent meaning that it's not that they can't be removed, but they have to be removed by an act of Congress. So that's really what they mean when they say permanent. We're going to actually go back to the state and local tax conversation and connect it with business owners, as I promised you, by mentioning the pass-through entity taxation. What this means is we mentioned that there is a $10,000 cap on what you can claim on a federal tax return for paid state and local taxes that is going to temporarily increase to up to $40,000. Well, during the Tax Cut and Jobs Act era, what businesses would do to evade or get around or claim more than that cap is they would have a pass-through entity such as an S Corp to pay higher than the limit at the business level. So for example, if you had an S Corp owner who had $40,000 worth of state and local taxes, they may choose to pay $30,000 of that through the business at the state level and then claim the remaining $10,000 up to the cap on their personal tax return. Now, this is something that a lot of people don't like. They see this as business owners being able to evade this law in a way that people who are not business owners are not able to, which is true. And a lot of people thought that they would remove the ability to do pass-through entity taxation, but they didn't. They cemented it and made it permanent. So because there are really, really high income business owners out there who may even be above the phase-out range to take that $40,000 cap, which will eventually go back to $10,000, because there are people out there who are saying, hey, why not, take advantage of this as a business owner? You will still see the pass-through entity taxation being used in a strategic way. And if you are a business owner in a state that charges state income tax and we're not aware that this was an option, doesn't mean that you should or shouldn't do it. It does at least mean that you should talk to a tax professional and ask them to walk you through the pros and cons. Next up, the federal income tax brackets. So you may not be aware, even though we've gone through how taxes work many, many times on this podcast, that the IRS has the ability to change those tax brackets from year to year. And the Tax Cuts and Jobs Act actually brought them down and reduced the income brackets in terms of how much you pay in terms of a percentage. And in some instances, it even increased the amount of income you could claim at the lower levels in terms of what you pay. So those were due to expire, those tax brackets, at the end of the Tax Cut and Jobs Act, which is the end of this year, 2025. But the One Big Beautiful Bill Act has made those permanent. So instead of trying to figure out what it could be increased to over the years, and we've talked about how do I predict what I might pay in the future, you now have, at least until Congress overturns it, some level of certainty that the federal tax brackets are going to be set at 10%, 22%, 24%, 32%, 35%, and 37%. And we will put in the show notes a link so you can see what income falls within those brackets in the year 2025 based on your filing status. Along that same vein, where we're talking about tax brackets, is the standard deduction. So you will recall that the standard deduction is an amount of income that you can use to reduce the income on which you pay taxes, regardless of your tax status. So whether you're single, married filing jointly, married filing separately, everybody has access to a standard deduction at some level. That standard deduction was almost doubled through the Tax Cut and Jobs Act. Again, that was due to expire at the end of 2025. This bill has made that increase permanent, and it will be indexed for inflation. So more and more people, especially if you're not, again, a really, really high income earning taxpayer in a state that charges state income tax, will choose to use this standard deduction because they'll get more benefit from it than writing out all of their itemized deductions, unless, again, they earn a lot of money, have a really expensive home where they pay a lot of mortgage interest, give a tremendous amount to charity. That's kind of the profile of a person who might choose to itemize, but otherwise they will likely choose the standard deduction because of this increase. Next, let's talk about some family tax deductions, starting with the Dependent Care Flex Spending Account. I love Dependent Care Flex Spending Accounts. I think it is one of the most overlooked deductions in employee benefits when it comes to what you have access to at your job. As a reminder, if you have a child that's under 13, up to this point, you as a joint taxpayer have been able to put up to $5,000 before you pay taxes on that income into these accounts, and it can be used for a tremendous number of expenses. And under this bill, they are increasing the amount that you can put in these accounts to up to $7,500 starting next year. So that's something that, again, is a tremendous benefit, especially if you have expensive daycare or a pre-K, or if you have an expensive aftercare program or summer camps. This is something that you want to make sure that you can use, and if you can use it, that you choose to do so. While we're on that subject, the child tax credit is something that you can use regardless of whether you have some benefit to you at work. And that increase is permanent. It was increased through the Tax Cut and Jobs Act, and that's going to start at $2,200 next year. We were talking about employee benefits. Let's keep going along that thread and talk about health savings accounts. Health savings accounts are another employee benefit that I've told you is underused. The way that it works is you have to sign up for a high deductible health plan, which in most cases will save you some money because it's a lower cost premium because you're responsible for a higher deductible. But if you have that account, you can pair it with a health savings account. As a part of this bill, they have increased the number of plans that are eligible to partner with a HSA. So it opens up the opportunity to both have lower premiums for these plans and also an above the line tax deduction that's really useful. So this is something that you should pay attention to, where if you wanted an HSA in the past, but you didn't have a health plan that was eligible to partner with one, that may be changing as a result of this bill. Next, while we're on the topic of deductions, we talked about health savings accounts. Those are above the line tax deductions. Let's go to a below the line or an itemized tax deduction, which would be charitable contributions. So this bill has made some unique changes for either side of the fence. First, let's talk about someone who takes the standard deduction. In years past, if you take the standard deduction, you have not been able to get any taxable benefit for the money that you contribute to charity because that's an itemized below the line deduction. This bill changes that, and it would allow even people who take the standard deduction to deduct up to $2,000 in charitable contributions. That's how it treats people who take the standard side. Now, for people who itemize and choose below the line tax deductions, you still can take a tax deduction for those charitable contributions, but it actually creates a floor for what you can claim that hasn't existed in the past. So prior to this change, if you gave $10,000 to charity, you'd be able to take that entire $10,000 as a below the line tax deduction. Now, what they have done is they have created a floor of 0.5% of your income that you have to clear before you can claim any remaining charitable contributions. So, for example, let's say that we have someone who earns $100,000 and they contribute $2,000 to a local charity. Well, now this 0.5% floor has been created. 0.5% of their $100,000 income is $500. So if they gave $2,000 to charity, they would have to subtract that $500 floor, and they would only be able to claim the remaining $1,500. So in some senses, they made it easier and more beneficial for people who claim the standard deduction, and they made it more punitive for people who itemize by creating this floor that is admittedly small, but it didn't exist before, and it takes away some of the charitable contributions that you can claim on your tax return. And lastly, not in the sense that this is all that's in the bill, but in the sense that these are the things that I think are most relevant to our typical listener, the qualified business income deduction. We're not going to get deep into this deduction. I actually want to do an episode on it down the line. But the best way to think about the qualified business income deduction is, depending on your income and your industry, this deduction allows you to take up to 20% of your business income and deduct it before you pay taxes. This is another unique deduction in the sense that it's not an above the line deduction. It's not a below the line deduction. It's eligible for any taxpayer regardless of how they file. This is something where they thought that there would be some changes, maybe reducing the amount of income that you could deduct, or making it more beneficial for people who are in some specific industries that have kind of been limited in how much they can claim in the past. But this has been largely untouched. There are some small changes that we'll talk about when we have that episode, but they have made this deduction permanent. So this is something that definitely benefits business owners. I benefit from it every single year. So seeing it codified into law is something that will definitely present a long-term opportunity. So that was a lot. And as we shared at the beginning of this episode, this is kind of for people who already have some familiarity with the tax return. And it is not to simply say, oh, you need to just call your tax professional or financial advisor because they're the only people that can help you. But I do hope that you kind of see when we tackle some of these topics that there is a benefit in having people on your team that do this full time. There's a lot in this bill. There are things that if you didn't know that they existed, you may not even know to track that expense and let your tax preparer know so that you can benefit from it for your upcoming tax return and in years that follow. So I would encourage you, if you are in a position where you know, based on some of the things we covered in this episode, that you would be impacted, to consider, if you're not already, partnering with a tax professional, partnering with a financial advisor to help at least track some of these things for you and have an additional level of oversight to make sure that the things that could harm you don't harm you, and the things that you can benefit from are reflected on that tax return in the years to come.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.